Okay, the data drops right now. So if you parse through it, it looks on the headline that it actually came in stronger than estimated. You had annualized GDP coming in 2.1%. Now, personal consumption was a touch weaker, coming in at 1.8%. Personal consumption was what was supposed to be holding everything up. So that's an interesting point. Also, core PCE on a quarter-on-quarter basis coming in real light, coming in at 1.3%. Clearly not seeing any sort of filter through from those tariffs into prices. And initial jobless claims coming in bang in line, 216,000 as the job market continues to hold steady. That's interesting. The personal consumption one I find interesting.
The personal consumption, obviously, we were expecting that slowdown. Obviously, it was worse than estimated. The non-residential fixed investment actually came down, too. That was down 1.5%. Now, that deceleration is actually an improvement what we saw in the previous quarter. But again, a lot of folks were expecting a rebound there. And then also the final sales to private domestic purchasers, that was up 1.4%. Estimate was for 2.3%.
Yeah, and you could see even bigger cutbacks in business investment going forward, especially as you have Boeing 737 MAX kind of weighing on the production line and how that winds up filtering through, too.
This is an interesting report. I mean, the market reaction is pretty subdued here. I mean, this isn't a great report, but it doesn't necessarily show any significant weakness in the economy, or at least any weakness beyond what some folks had already started to price in.
All right, joining Romain and I is Jan.30 Bloomberg Intelligence Chief U.S. Interest Rate Strategist. Hey, Ira, what do you make of the numbers?
Yeah, so clearly a little bit weaker than expectations. I think the worry here is not so much these numbers, because these are backward-looking. There's other risks that have creeped up into the market. So I think that if you're a bear and you think that the economy was going to slip, well, you got confirmation of that today. Those personal consumption numbers, in particular, I think have to be the most worrying, primarily because the consumer has really been propping up the economy while the manufacturing sector has slipped over the last 18 months or so. So if the consumer really is going to start trending lower and you're not going to have the same amount of consumption, you have to really start to worry about the economy a bit.
Ira, how much distortion is there in these numbers? There was some concern that with the trade war and imports being pulled forward, that this number might actually not reveal as much as some people thought.
Yeah, I think that's true. And, the problem with the GDP report is that there's a lot of numbers that are in there. So there could be one or two numbers that are distorting things a bit. But at the same time, it is the broadest reading of the economy that we have. So, again, I still think that for the Treasury market, it's really the January numbers that are going to wind up driving things even a little bit more than we've seen over the recent past, today's bull flattening aside. So the Treasury market, the next important level is 1.5%. And if the economy slows down further, we could retest those lows down another 10 or 12 basis points from there.
Just to wrap it up with the consumer, are you worried about the consumer, considering that this was a holiday shopping season and consumer spending actually moderated? Business investment, we kind of knew.
Well, so we don't have all of the final reads on the holiday shopping season. So we got advanced retail sales. We need to get the final report on that. That will feed into the personal consumption numbers. So you could see a modest revision upward toward what the market was expecting. That 0.2 revision upward would not be surprising when we get the next release of fourth quarter GDP in a month. But yes, the consumer is the single most important part of the economy right now that you have to be really focused on. So the jobs report next Friday ends up being, I think, very important, particularly the wage component of that. So you can wind up having only 80 or 100,000 jobs, but you need wages to be growing.